Yeah, I'm losing my edge.
Managing stock risk with bonds is the topic of conversation here today, Pete. And this is going to be a great one. We've talked about managing stock risk, long or short portfolio portfolio items there in the stock world with options or with stock futures and all these different things. I mean, I would maybe contend that the most traditional hedge for a stock position, Pete, is the bond market. People who aren't even active traders but have IRAs or 401ks, they unknowingly probably have a stock and bond fund,
Right.
which the whole point of that is to manage stock volatility with some long bonds in there. So I want to show that's the way that you would have done it maybe 10, 20, 30 years ago, where you didn't have access to easy access to
Right.
trading stocks and bonds in an active, cheap way like you do now with small exchange products. And so they would just put them in a fund. And so year after year, you would just be long some stocks and long some bonds. Today in 2020, you've got so much more access. We just came out with a new bond product that's so small and easy and simple for you to digest, understand, and trade here in S10Y. And so let's get into the 2020 version of managing stock risk with bonds. And we'll start here with S10Y, the small treasury yield futures, a product that doesn't require a prior seminar in fractions, or a DV01, which stands for dollar value of a basis point, by the way, if you didn't know that. But immediately discard with that information. Take that out of your memory.
I was going to say, we are no longer using those bad terms.
Absolutely. And we're doing away with all of them. All you have to focus on is yield here. First product price and yield moves about $40 a day. Conventional pricing, if the 10-year yield is at 95 basis points or 0.95%, our price is going to be at $9.50. Going to look exactly like that. No more worrying about, 137 and 10/30 seconds. That translates to 0.95%. No more worrying about any of that. And we've talked about this a little bit, Pete. Hopefully people are a little more comfortable with creating an opinion around rates in their own right. We've talked about mean reversion. That was a great episode that we did. We talked about, just trading. Are rates going back to normal, or are they going to this negative trend that we've seen at other central banks throughout the world, and formulating that opinion? But today, I want to see how those opinions align with a stock trade, what the correlations are, and how you pair these two things together. Because you look at this chart, Pete, and for a good part of it, the correlation looks pretty positive between stocks and yields.
Absolutely. And that is what we would expect. We've always looked at that inverse relationship of price quoted convention. This becomes and it's interesting because there is more dynamism or ebb and flow to this pair than there has been probably in the first 20 years I traded, where they really moved tick for tick. I mean, there were 300 monkeys, and me included, standing in the S&P pit, staring at the boards, looking at where the bonds were trading. And I'm sure the other 300 monkeys 5 blocks away were looking to see where we were trading, trying to get an edge. And they moved in that tick for tick basis. Here, you know what? This is what we want, is products that move together, that start to disconnect and give us opportunities. And you've certainly highlighted that opportunity here.
Absolutely. Because, what we have here in orange is the small exchange stock market, small stocks there. And what we have in white is the small exchange treasury market, the small treasury yield. And you can see pretty high correlation. Rising here throughout 2018, a little bit of turbulence here in 2019 coinciding. And then it's almost like this break here in 2019 where stocks continue to take off, and then treasury yields just trend lower. And, it's funny that you bring that up, because Pete's talking about his days of trading in the pits, a decade, 2 decades ago. When I hit the Chicago Board of Trade, this guy sat next to me, Larry. He was an amazing guy. He should be studied for 10 different reasons. He's a nice guy, but he was like you traders from the pits, which is to say different than us millennials. But he would sit there and he would yell at his screen, because we'd be trading treasuries primarily, but he'd be looking at stocks,
right?
And he'd be long a bunch of treasuries, and he would see that stocks are falling. And he's like, these things should be up 20 points from here, because they used to trade tick for tick. Like you're saying, he was remembering those days of the aughts or the 90s.
Why am I not getting paid? Yeah.
Of the eight. Oh my gosh. I thought he was going to hurt his computer and or me, because he's like, oh my gosh, these S&Ps, they're rallying. These bonds should be lower by 30 ticks. But yeah, this has been a break in convention here, which has translated to still a really good correlation, honestly. Like, this is still a market that I would go to hedge stock risk, because you're seeing here the correlation. It may be in the 80s, 90s, and 2000s was closer to 0.7, 0.8, or 0.9 here, but still a lot of green in the correlation.
Right.
Very consistent. Very rarely, I would say maybe 1 out of every 5 days, we see these markets moving in different directions. And so you still hang your hat on this for managing stock risk, right?
Yeah, absolutely. It is. And you know what? I think in a Pavlovian way, this is probably the first spot you go to. And I think it's taken a fair amount of time, but that's kind of been beaten out of you a little bit for that tick for tick. But absolutely, this is, and I think we've done this. We've actually used other ways to trade the pair here and found it to be a really effective vehicle that gives us a hedge, and a hedge in terms of time. So this relationship is one that before S10Y, before small tens, was difficult to pair in an appropriate fashion, an appropriate size. It really became a challenge. So yes, the positive correlation, strong positive correlation. This is where we like to live in terms of relationship trade. And I like the fact that a pairs trade is one thing. Managing your stock exposure is another on both sides. And that's where it becomes really something you can use dynamically during the day. It's a powerful addition of product.
I'm glad that you bring up the pairs, because we're going to get to that in a second here, because you're absolutely right. That correlation that's green, that's high, but not too high, leaves a lot of leeway for managing risk, but also trading pairs. But just to finish up here on managing that risk, how do you hedge a stock portfolio? Well, here's the thing. If I'm long stocks, then to hedge against this, I want to be short S10Y and vice versa here. And I outlined just a couple of stock portfolio values down here at the bottom, and how many S10Ys you would want to use to hedge that. And as you can see here, Pete, I remember this from taking the ACT and everything, and I wonder if it was the same for you, where it was just like, can you tell from this pattern, Pete, how much the S10Y equates to in stock value?
Yes, I think I do remember that. But remember, when I took the SAT, it was much fewer questions because we actually had to answer them on a stone tablet chisel.
Oh, that's true.
It took more time, but yes. So you know what? I think this is, and we got used to long, short as the trade. Those pairs trades are hard to just, again, those are for so many of us, it's just too much. I don't get the long, short pairs trade. Here we're able, with a yield-based product, to do our traditional long, short pairs trade. And, you talk about how we can scale in the hedge here. This is, it's a very symmetrical scale, which is really powerful.
Yeah, absolutely. It is. We're going to probably get some static from people who are like, well, I'm used to selling stocks and selling treasuries.
Right.
And if anything, I understand that this is maybe a hump to get over, but that was more confusing than this. Yeah. This is the easiest way for me to think about managing risk or pairs trading is I've got two things that are similar here that move together, and I want to buy one and sell the other. So if I'm long stocks, I don't want to be long yields here because of this correlation, they tend to move together. So if stocks move lower, my yields are probably moving lower, and that's no longer a hedge. I just doubled up my risk there. And so, what you can see here is that with the volatility here in yields and the size of this product, one S10Y contract would hedge about $3,000 worth of long stock exposure. And so on the small exchange futures in the stock world are about $6,000. So you use about 2 S10Ys per one stock product in the small exchange. But it's the same goes if you've got, $10,000 worth of SPY ETF shares, or wherever your equity exposure is, just keep in mind that it's about $3,000 worth of equity exposure that would hedge 100% of that. And you can mess with this. However, say you've got 50 grand in long stocks and you want to hedge 50% of that 50 grand, that's about 25 grand. And so I would use about 9 or 10 of these S10Ys. It's just a matter of making it however you want there. And the reason to take this extra step, not buy the stock or bond fund and then just put it away for the next 10 years, is because you get to take advantage of stuff like this. The fact that I can be long stocks here, this orange line from right here, about $45 all the way up to, hey, new highs recently here at above $60. And I can say, now I will put on my hedge, as opposed to putting on the hedge here. You lost a lot in the long bond trade while you made a good amount here in the equity trade. But you could say to yourself, oh, I'll put on a little bit of the hedge here. I'll take some of it off with bonds at highs. I'll put my bond. It's just the active trader just gets so much more flexibility, and these products afford you so much flexibility. And with that, I want to conclude at the Degenerate Corner here, which is pairs trading. We love talking about managing risk, but we are at the end of the day degenerates, and we love to speculate on stuff. And Pete, this is a great pairs trade. This is maybe one of the most classic buy sell trades, like we were talking about to start the show out. Where if equities are higher and yields are unchanged or slightly lower, that's a great sell equities, buy yields trade, and vice versa. Like we see today, where yields are slightly higher, equities are selling off, 1 or 2%, might be a good long equity short yields play. This is one of the classics, right?
Absolutely. And I think, with SM75 down, 70 ticks and the sticks almost down 100, there is, are we trading off of these incredibly high levels? And has this been a pretty quick break?
Sure.
Yes. But if you want to trade both sides of the market, I'd love to be able to do it with a little bit of that extreme as a hedge. I mean, that is where starting in the pit trading one product and trading one lots to moving to the point where you actually manage the portfolio and looked at correlations like this with elasticity are a pairs trader's dream. And this is where you defend ideas and strategies that you have by using tools like this. So it's a great segment, Frankie, walking through both of these and the opportunities they have, both on a longer term strategic basis, as well as a shorter term, scalping the range basis.
Yeah, it's crazy how many doors adding the asset class of bonds has opened for us here at the small exchange in terms of trading opportunities. So yeah, there it is, managing stock risk, one of the most traditional ways to manage stock risk with bonds here at the small exchange, with a little bit of flavor of that degenerate pairs trading between the two, which is a great trade that I think everyone should look into, especially if you're new to pairs. Great first foray into that. So thanks so much.